All right. So this is actually 811 here. I have 812 in this box here, but this is not 812. 812 is the next one we're going to do. This is all for 811. Okay, this was all problem 811. Okay. So I am going to move problem 811 out of our way. I'm going to move it down here. I'm going to move all this information from 811 out of the way. Move it down here. And we're going to work on 812. All right, so 812 on page 837. So let's see what this one says. It says these transactions took place for Branson Company, and there's one May 1 and December 31 for 2021, and then there's May 1 for 2022. Record the transactions in the general journal. The company does not make entries to accrue interest except at December 31. All right, so May 1, 2021, received a $5,000 12-month 6% note in exchange for an outstanding accounts receivable from R. Stoney. So May 1, we're going to debit notes receivable. And we're debiting notes receivable for $5,000. And we're crediting accounts receivable because they told us that it was for settlement of an accounts receivable, right? Settlement of or they say exchange. It can say exchange or it can say settlement, okay? All right, so we have that one. We're going to go down to the next one. Oh, I should probably put 2021. So we've got 5/1/2021. Okay, May 12, 2021. I didn't change it. May 1, 2021. There we go. Okay. Now we're going to go down to the next one. December 31, accrued interest revenue on the R. Stoney note. So we come back over here to interest rate, or interest equals face value times rate times time. So the face value is $5,000. Oops, $5,000. Times the rate, and the rate on this note was 6%. Times the time, something over 12, because it said it was a 12-month note. It's a 12-month note, so something over 12, okay? So we have to ask ourselves the question, when was the last time interest was done? They tell you in this problem that interest is done on, sorry about that. They tell us that interest is done on the 31st, and on May 1, when the interest was originated, December hadn't come yet, right? So now we're at the 1st December. So we have to do interest so interest has never been done. So we have to do interest from the date the loan originated to the date that we are accruing the interest. So for this note, what we have to look at then is all of May, all of June, all of July, all of August, all of September, all of October, all of November, all of December. That's 8 months. 8 months. May, June, July, August, September, October, November, December. 8 months. So our problem becomes $5,000 times 0.06 times 8/12. Or if we take that 8/12 to fractions, it becomes times 0.6666. Okay. So the interest for those 8 months is $200. Right. So on December 31, 2021, we are going to debit interest receivable for $200, and we're going to credit interest revenue for $200. All right, so that's December 31, accruing of interest. Now we're going to go to May 1st, 2022. Received principal plus interest on the R. Stoney note. No interest has been accrued since December 31, 2021. So we ask ourselves, whenever we're making a payment or we're doing an accrual, we ask ourselves, when was the last time interest was done? So in this case, the last time interest was done was December 31, 2021. And the next thing we ask ourselves is there a gap in time from the last time interest was paid to the date that we are paying the interest? So it was done on December 31, and now we are at May 1. Is there a gap in time? Yes, there is a gap in time there, okay? So now we have to bring the interest current, okay? We have to figure out what the interest is to bring it current. So we're going to take that same formula from before. It's going to be $5,000 times 6% times something over 12. What is the something over 12? So let's see. We last did December 31. So we have to do all of January, all of February, all of March, and all of April. None of May because we're paying it on May 1. So all of January, all of February, all of March, and all of April. So that makes it 4 12ths. Okay, 4 12ths. Oh, let me go back over here. 4 12ths. That makes it 4 12ths. And 4 divided by 12 is 0.3333. So $5,000 times 0.06 times 0.3333 is $100, right? Now, I'm going to tell you something. You might be tempted to look up here and go, oh, well, the last time I did interest, it was $200, and that was for 8 12ths. This is only half as much, 4 12ths. So I can just divide the last amount of interest in half. Be very careful because sometimes you have an odd number and you're not going to get the problem right. So always multiply out to get your answer. Okay, don't just take the prior interest and divide it if it's half as much. Always multiply out, okay? This time it's a round number, so it works, but it's not always going to work, okay? All right, so we have $100 of interest, which is the current amount of interest that we've earned that hasn't been posted yet. So we have to take that into account when we post the payment, all right? So this is May 1, 2022, all right? So the first thing is we're going to get cash. And how much cash are we getting? Well, we're getting the original amount of the loan, which is $5,000, plus we're getting the $200 in interest that was accrued, plus we're getting an additional $100, which is for the additional interest that we just earned for that last period, okay? So we're going to get $5,300. That's how much money we're going to get, okay? Then we're going to credit notes receivable to get rid of the note, and that's for $5,000. We are then going to credit interest receivable for the amount of interest that we prior had charged, which was the $200, the prior interest charge. And then we are going to credit interest revenue for the current amount of interest that we just figured out, the $100. Okay, that's $100. $100. So then this first entry here is the issuance of the note. The next entry is the accrual of interest. And then the next entry is the payment of the note and interest when the interest was not current. So we had to do an entry to bring the interest current. Okay, and that's why we have the additional entry there. All right, so that's exercise 812 on page 837. And I'm going to stop the recording there.